At 11:08 a.m. EST on December 30th, 2025, COMEX silver futures flashed an inversion signal. Front-month contracts bid higher than deferred months, the deepest backwardation witnessed in decades as spot premiums overwhelmed normal market structure. Meanwhile, Shanghai physical premium surged to $8 per ounce over COMEX futures, a divergence that screams system failure rather than temporary dislocation. Spread anchor crystallizes the breakdown. Physical price on Shanghai Gold Exchange at $78.49 per ounce versus COMEX futures near $70, yielding a collectible premium of 11.4% in physical over paper. Napkin math exposes the abnormality. Typical premiums measure in cents, maybe $1 at stress peaks. Now they measure in $8, representing more than 10x normal range achieved within hours. Screen calm versus physical chaos. On trading screens, futures prices oscillate in orderly ranges. In dealer feeds, physical asks evaporate as out-of-stock warnings replace bid offer quotes. If you just joined, understand this. This isn't volatility. It's structural divergence between the paper market and physical reality, and the system is now stress-testing delivery mechanisms that were never designed to handle simultaneous conversion demands from paper into metal. By 9:27 a.m. London time, LBMA silver spot traded $1.15 above COMEX nearby futures, an inversion that represents the steepest spot premium over futures witnessed since the 1980 Hunt Brothers squeeze when market structure collapsed under delivery pressure. Record contango that typically keeps futures above spot by carrying cost margins flipped into backwardation within a single trading session, spot commanding $2.50 premium over futures where typical spread hovers within plus or minus 10 cents. Immediate viewer context clarifies the mechanism. Backwardation signals urgent delivery demand, a market condition where holders value immediate possession over deferred promises, typically appearing when physical scarcity overwhelms paper abundance. Spread anchor data confirms the abnormality. London spot at $72, while December COMEX futures traded near $70, a premium that arbitrage should eliminate within minutes, but instead persisted through morning trading and widened as participants tested the market's ability to deliver metal at quoted prices. One LBMA dealer's quote screen showed spot bid $71.85, offered $72.15, futures bid $69.75. A spread structure that invites arbitrage yet remains unclosed because the metal required to execute the trade either doesn't exist in accessible locations or won't move at prices that make the arbitrage profitable. This isn't normal risk where backwardation resolves through arbitrage buying futures and selling spot. This is delivery preference stress, where spot holders refuse to sell at premiums below what physical scarcity commands, and futures holders discover their contracts promise metal that warehouses cannot deliver. At 9:12 a.m. Shanghai time, Shanghai Gold Exchange physical silver printed at $8 per ounce premium over COMEX futures, a divergence documented by SGE's AG T+D contract closing at approximately 19,400 yuan per kilogram, while COMEX futures traded $70 per troy ounce. Inventory snapshot reveals the mechanism. SHFE vault holdings at decade lows, Chinese exchange stocks dropping below 446 tons, the lowest since 2016, with over 300 tons depleted in October alone as industrial demand from solar panel manufacturing, electronics production, and electric vehicle components consumed available supply faster than imports could replenish it. Spread anchor in RMB terms shows SGE physical trading at 2.5% premium basis over COMEX futures after currency adjustment, a gap that represents structural supply deficit rather than currency effect or regional preference. Observable market participant behavior confirms the stress. Chinese manufacturers bidding physical silver to premiums that exceed their profit margins on finished goods, industrial buyers accepting multi-week delivery delays rather than sourcing through paper markets that cannot deliver actual metal. One Shanghai-based silver refiner quoted by industry reports stated, "We're seeing unprecedented demand for immediate delivery. Buyers willing to pay any premium for serial numbered bars they can verify and take possession of today." This physical premium says supply isn't meeting immediate demand. It's not speculation about future shortage or concern about paper market reliability. It's actual consumption exceeding actual supply in the world's largest silver consumer market. And this premium established itself before London markets opened, meaning Asia's physical reality preceded Western paper price discovery, inverting the normal flow where COMEX and LBMA set global benchmarks. COMEX open interest for January delivery surged sharply at cash market open, contracts outstanding in the typically minor January month reaching levels that historically characterize major delivery months like March or September. Observable data shows silver backwardation signal accompanied by heavy roll activity, traders refusing to extend positions into later months and instead demanding near-term settlement, behavior that indicates preference for immediate delivery over deferred exposure. Mechanism clarification reveals the pressure. Near contracts bid by physical holders unwilling to wait, institutional inventory managers who need actual metal for manufacturing processes, or allocated storage commitments paying premiums to secure January delivery rather than rolling to March at discounts that reflect the inverted curve structure. Market venue data from CME Group shows January open interest at record highs for minor months, according to SchiffGold's analysis. A deviation from historical patterns that signals robust demand for physical settlement, despite already elevated inventory levels that should theoretically satisfy normal delivery demand. Direct address frames the asymmetry. They, the institutional inventory managers and industrial consumers with access to exchange delivery mechanisms, are tightening what you, the retail investor or small institutional participant without direct warehouse access, can obtain through normal dealer channels. One futures analyst monitoring COMEX activity noted, "We're seeing contract holders willing to accept backwardation losses just to secure near-term delivery slots, a preference pattern that only appears when participants doubt their ability to source metal through normal channels at later dates." Open interest doesn't lie. Delivery demand is rising while registered inventory available for settlement continues depleting, a mathematical imbalance that must resolve through either dramatic price increases that destroy demand or delivery failures that force cash settlement. This market hasn't seen persistent backwardation like this since 1980's Hunt Brothers era, when open interest and deliverable metal availability decoupled violently and forced exchange intervention through trading restrictions that bankrupted speculators who had accumulated positions using leverage. Regulatory posture and margin tightening now restrict natural arbitrage that historically stabilized such events. CME's recent margin requirement increases from $20,000 to $25,000 per contract remove leverage that arbitrageurs use to bridge spot futures gaps, reducing market participants' ability to close backwardation through simultaneous buying of underpriced futures and selling of overpriced spot. Venue comparison reveals the paper market dominance problem. COMEX futures volume measures in hundreds of millions of ounces traded daily, while SGE physical trades measure in tens of millions, yet the physical market with lower volume now dictates pricing through premiums that futures must eventually match or face delivery failure. Data analysis documented by Discovery Alert shows futures contracts outstanding exceed deliverable metal by ratios exceeding 300.1 when measured against immediately available registered inventory. A fractional reserve structure where paper claims vastly outnumber physical ounces backing those claims. Mechanism explanation clarifies the danger. Paper claims overwhelm metal available for physical delivery, creating a system where most contract holders cannot simultaneously convert their positions into actual metal without exhausting warehouse stocks and forcing cash settlements at prices disconnected from physical reality. Observable market behavior confirms the stress. In early December 2025, more than 60% of COMEX's registered silver inventory, approximately 47.6 million ounces, was claimed for delivery in just 4 trading days, an unprecedented depletion rate that overwhelmed the warehouse system's capacity to process delivery requests and convert eligible inventory into registered status fast enough to meet demand. Viewer tie-in makes the consequence personal. Your paper win, showing profits on screen, could be worthless at delivery when the exchange mandates cash settlement at futures prices, while physical metal trades at 11% premiums in Shanghai, and dealer markets charge 15% premiums for bars you can actually take possession of today. Back in the warehouse, documented by CME Warehouse Reports, there's no metal available to satisfy bids at prices that paper contracts specify. Registered inventory that should theoretically settle against outstanding contracts has been depleted through actual delivery demand, exposing the fractional reserve nature of the futures system. Dealer inventory snapshots reveal the physical reality hidden behind screen prices. Major bullion sites posting out-of-stock warnings on serial-numbered bars, 1-ounce rounds, and even 10-ounce bars that typically trade with immediate availability. Observable premium behavior shows allocated metal, silver with specific serial numbers assigned to specific owners, commanding premiums vastly exceeding generic storage or unallocated accounts where multiple claimants hold fractional interests in pooled inventory. One major U.S. dealer's website updated at 10:47 a.m. EST. American Silver Eagles, out of stock, back order 4 to 6 weeks. Canadian Maples, limited availability, $12.50 premium over spot. 100 O's bars serial numbered, sold out, no ETA. That message captures the disconnect. Screen prices showing silver at $70 while actual acquisition cost for physical metal exceeds $82 after premiums, a gap of $12 or 17% that represents the difference between paper promises and metal you can hold. Mechanism clarification reveals why allocated metal commands extreme premiums. When you own allocated silver with serial numbers registered to your name in segregated storage, you possess deliverable metal that exists independent of the paper market's fractional reserve claim structure. metal that cannot be rehypothecated or claimed by multiple parties simultaneously. Market observers watching dealer premiums throughout December documented premiums on retail silver products climbing from $3.04 over spot at month's start to $9 to $12 over spot by month's end, a tripling of premium spreads that occurred while screen prices rose only 15%, proving that physical scarcity intensified faster than paper prices could adjust. Escalation frames the trap. Try fulfilling delivery on any significant purchase order. Physical stocks are gone from dealer inventories. Refiners report backlogs extending weeks, and mints cannot source sufficient blanks to strike coins at rates matching demand, creating bottlenecks throughout the supply chain where each step from raw material to finished product faces constraints that prevent rapid supply response to rising prices. Arbitrage channels that should equalize London, Sydney, and New York spreads have broken entirely, a failure documented by persistent price divergences across venues that normally converge within minutes through high-frequency trading algorithms. Transport and logistics constraints compound the breakdown. Theoretical silver cargo flights remain unused, not because transportation doesn't exist, but because the metal required to execute arbitrage trades cannot be sourced at origin points where futures trade below spot, meaning arbitrageurs cannot buy futures, take delivery, and ship metal to premium markets because warehouse stocks won't deliver against futures contracts at prices below what physical holders demand. Discovery Alert's analysis of failed arbitrage shows the mechanism. When Shanghai trades $8 above COMEX and London trades $2 above COMEX, arbitrageurs should buy COMEX futures, demand delivery in New York, ship metal to Shanghai or London, and sell at premium prices for guaranteed profit. But this arbitrage fails because COMEX warehouses either won't release registered inventory for delivery against futures contracts or demand premiums above futures prices to convert eligible inventory into deliverable registered status, breaking the price linkage that keeps global markets aligned. Observable consequence appears in cross-venue spreads that widen rather than narrow as trading day progresses. Shanghai premium started at $7 per ounce in Asian morning trading and reached $8 by afternoon close, while London premium over COMEX widened from 1.15 to 1.85 during overlap hours, both spreads moving in directions opposite to what arbitrage should force. One commodity trading desk source quoted by industry publications stated, "We're seeing arbitrage opportunities of $5.88 per ounce that we cannot execute because the physical metal won't move. Either it doesn't exist where exchanges claim it does, or it's encumbered by claims we can't legally pierce." Viewer Hook frames the impossibility. That profit wedge you see on screen representing the spread between cheap COMEX and expensive Shanghai won't fill a warehouse because the system preventing arbitrage execution is the same system preventing your paper contracts from converting into metal at prices those contracts specify. Price discovery has fractured into separate regional markets with divergent prices and no mechanism to force convergence. Paper exposure risk crystallizes through settlement mechanics that create asymmetric outcomes between cash and physical holders, structural danger where cash-settled positions may not reflect real metal value when divergence between paper and physical exceeds normal bounds. Mechanics clarification reveals the trap. Cash settlement favors shorts who sold contracts they cannot deliver, allowing them to close positions by paying contract holders cash based on futures prices rather than delivering metal at prices reflecting physical premiums, effectively disadvantaging allocated holders who expected either physical delivery or prices that reflect physical market reality. Data showing rapid lease rate spikes confirms the stress. Borrowing costs for physical silver that normally hover near 0.5% annually have surged above 14%, with intraday spikes touching 24%, rates indicating severe scarcity of metal available to lend for shorting or financing positions. Explanation connects the mechanisms. Backwardation means convenience yield is high, reflecting that near metal beats future claims because immediate possession provides value that deferred delivery cannot match, whether that value comes from satisfying manufacturing demand that cannot wait or from securing allocated storage before remaining inventory exhausts. Viewer risk becomes personal. If you hold only paper exposure through ETFs trading at spot prices or futures contracts promising delivery, you may be wrong when delivery counts because your paper claims settle at prices disconnected from the premium physical metal commands, leaving you to buy actual metal at dealer premiums if you need physical possession rather than cash settlement. Exchange rulebooks explicitly grant authority for cash settlement. In the event of force majeure or circumstances that make physical delivery impracticable, language protecting exchanges and clearing members at expense of contract holders who assumed their positions represented real metal rather than financial bets, settled in fiat currency. Market precedent from LME's March 2022 nickel crisis demonstrates the mechanism. When delivery obligations threatened to exceed available supply, the exchange suspended trading and forced cash settlements at prices far below where physical metal traded, protecting shorts who sold metal they didn't own while denying longs, the market gains their positions should have captured. They settle on cash. You lose physical parity, receiving payment based on exchange-determined settlement prices, while physical metal simultaneously trades at double-digit premiums in dealer markets. You cannot access at prices your cash settlement would purchase. Delivery pressure builds as notices climb relative to metal available for settlement. Observable stress where registered COMEX silver shrinks, even as delivery demands increase. By mid-December 2025, delivery notices for January contracts reached levels exceeding typical minor month patterns, contract holders demanding physical settlement rather than rolling positions forward or accepting cash closeouts, behavior indicating preference for actual metal possession over continued paper exposure. Observable metric shows registered inventory dropping while notices outstanding increase, creating a scissors pattern where supply available for delivery declines as demand for delivery rises, a convergence that must resolve through either metal arriving from external sources to replenish warehouses, prices rising enough to destroy delivery demand, or exchanges intervening through forced cash settlement or delivery delays. Mechanism explanation clarifies the pressure. Forced sellers, participants who sold contracts short, or market makers providing liquidity, must either deliver metal they don't own or buy back their positions at prices reflecting the squeeze, and as available inventory exhausts, their options narrow to paying premiums to source metal from spot markets or negotiating with exchanges for cash settlement relief that transfers their delivery obligations into monetary payments. One COMEX warehouse operator, quoted anonymously by industry sources, described the situation. We're processing delivery requests at rates we've never seen outside major delivery months, and we're running into bottlenecks where contract holders demanding metal exceed our ability to allocate inventory, creating queues where earlier requests get filled while later requests face delays or potential cash settlement if metal doesn't arrive. This mechanism exposes the fractional reserve vulnerability. The system functions perfectly when small percentages demand delivery, but breaks when significant percentages simultaneously convert paper into metal because aggregate claims vastly exceed aggregate inventory. Notices are demands backed by contractual rights to physical delivery at prices specified in futures contracts, and metal isn't moving fast enough to satisfy those demands without either premium payments above contract prices or delivery delays that violate settlement terms, forcing exchanges toward intervention through rule changes that protect system stability at expense of individual contract rights. Geopolitical demand for industrial silver in Asia amplifies physical scarcity beyond normal consumption patterns. Chinese manufacturers need silver for solar panel production that has grown 64% year over year, electric vehicle components requiring 25-50 grams per vehicle across power electronics and battery systems, and semiconductor fabrication where silver's unique conductivity properties make substitution either impossible or economically prohibitive below $2,000 to $4,000 per ounce. Export-driven drawdowns intensify physical scarcity as China prepares to implement export licensing requirements effective January 1, 2026, regulations that restrict silver exports to large state-certified producers meeting minimum tonnage and credit thresholds, effectively blocking 60-70% of global refined silver supply from international markets and forcing domestic allocation ahead of export availability. Mechanism connects policy to physical reality. Structural supply deficit versus extraordinary industrial need creates a situation where annual production of 813 to 835 million ounces fails to meet annual demand exceeding 1.2 billion ounces, generating cumulative deficits that deplete above-ground inventories by 300 plus million ounces annually, equivalent to consuming nearly 1 full year of global mine production from existing stockpiles within each calendar year. Observable data from Silver Institute reports documents 5 consecutive years of structural deficits totaling 800 million ounces from 2021-2025, inventory drawdowns that have depleted COMEX registered stocks by 70% from 2020 peaks, reduced London LBMA inventories to near all-time lows of 827 million ounces, with more than half allocated to ETF backing, and brought Shanghai Exchange inventories to decade lows below 446 tons. Geopolitical consequence frames the squeeze. When the world's largest consumer market, controlling 70% of global refining capacity, restricts exports to secure domestic supply ahead of international demand, Western markets face supply gap that cannot be bridged through immediate production increases because 75 to 80% of silver production comes as byproduct of copper, zinc, and lead mining, where production responds to base metal economics rather than silver prices alone. This isn't seasonal tightness that resolves when new supply arrives or demand moderates. It's structural imbalance where consumption permanently exceeds production, unless prices rise enough to either destroy industrial demand or justify primary silver mine development that takes years to bring online. Observable evidence confirms sustained premium and inverted curve persistence. Shanghai physical premium above $8 per ounce for the fifth consecutive trading day, backwardation depth in COMEX futures exceeding 60 cents on near spreads, and dealer premiums remaining elevated at $9.12 over spot despite screen prices near all-time highs that should theoretically stimulate supply response. Mechanism explanation invokes theory of storage from commodity economics. Backwardation signals inventory risk, where carrying costs cannot compensate holders for releasing metal into future delivery, a condition indicating either physical stocks are depleted below safety buffers or holders anticipate scarcity will intensify rather than resolve, making future availability more uncertain than current possession. Wikipedia's backwardation entry clarifies the signal. Backwardation occurs when spot prices exceed futures prices, typically indicating shortage in the spot market, as holders of the physical commodity prefer current delivery over future promises. Viewer address makes the consequence direct. If you don't grasp this divergence between paper prices on screens and physical premiums in markets, your exposure is conditional on the exchange's willingness and ability to deliver metal at prices your contracts specify rather than prices physical reality commands. Market history provides context. The persistent backwardation preceding the 1980 silver peak lasted weeks before prices exploded from $20 to nearly $50 in months, and the 2011 rally saw similar backwardation signals before prices surged from $30 to $49 within months, both episodes demonstrating that sustained curve inversion precedes dramatic price adjustment. The inevitability becomes mathematical. When paper claims exceed physical availability by 300.1 ratios, when delivery demand depletes 60% of registered inventory in 4 days, when physical premiums reach double-digit percentages while backwardation persists for weeks, the system faces binary outcomes. Either prices must move where physical demand dictates, rising enough to ration demand through price destruction, or exchanges must intervene through forced cash settlements that break the link between futures contracts and physical delivery, effectively ending futures markets as legitimate price discovery mechanisms for actual metal. Personal risk scenarios frame the divergence between paper and physical outcomes at settlement, exposing how contract type and storage method determine whether you capture physical premiums or accept cash settlement at paper prices. Viewer scenario analysis reveals the trap. Paper holders owning ETF shares or unallocated storage accounts may discover their positions settle at spot prices on screens, while physical buyers in dealer markets pay premiums that have reached $12, $15 per ounce, a gap of 15 to 20% that represents wealth transfer from paper holders accepting cash settlement to physical holders demanding delivery. Data showing physical buyers bidding beyond COMEX caps confirms the divergence. Shanghai industrial users paying $8 premiums, European buyers paying $6 to $8 premiums, and U.S. retail buyers paying $9 to $12 premiums all demonstrate that actual metal commands prices far exceeding futures settlement levels, yet paper holders receive only the lower futures price when their positions cash settle without conversion to physical. Consequence mapping quantifies the outcome. Loss of purchasing power versus loss of delivery capacity creates asymmetric risk, where paper profits fail to purchase equivalent physical metal, meaning a 20% gain on paper positions may yield zero gain in actual silver ounces if premiums have widened 20% during the holding period. One institutional precious metals dealer described the client experience. We're fielding calls from investors who sold physical silver last year to invest in silver ETFs for convenience, and now they're discovering they cannot buy back the same ounces. Their ETF gains are nominal, but their repurchase costs have risen faster than their ETF appreciated, leaving them with net losses when measured in ounces rather than dollars. Market structure explains why this occurs. ETFs and unallocated accounts hold fractional claims against pooled inventory where multiple investors own shares of the same underlying ounces. And when redemption requests exceed available inventory, late redeemers receive cash at spot prices rather than metal at premium prices. This gap can cost you real dollars measured in thousands per contract if you hold 5,000-ounce positions, or tens of thousands if you manage larger institutional exposure, wealth destruction through settlement method, rather than market direction. System prediction windows identify specific catalysts approaching on the calendar. Delivery deadlines where contracts must either settle or roll, contract expiration cycles forcing position decisions, and margin review dates where exchange adjustments to collateral requirements trigger forced liquidations or position closures. Observable triggers document the timing. January COMEX delivery period begins January 2nd, first notice day arrives December 31st tomorrow, and expiring calendar spreads lock participants into delivery obligations or cash settlement within 48 hours. Key pressure points compound through the holiday period when reduced staffing at warehouses, clearinghouses, and dealer operations constrains the system's ability to process delivery requests, convert eligible inventory to registered status, or arrange logistics for metal movement between vaults, creating bottlenecks that amplify stress from delivery demand. Viewer guidance provides actionable intelligence. Watch specific contract spreads. The January-March calendar spread currently in 30-cent backwardation signals participants willing to pay premium for January delivery rather than waiting for March, a preference that intensifies when participants doubt March will offer better availability or pricing than immediate settlement. Market venue data shows the pressure building. January open interest at record levels for minor months, registered inventory depleted to levels requiring eligible conversions to satisfy delivery requests, and lease rates remaining elevated, indicating borrowing stress persists rather than resolving. One futures market strategist monitoring COMEX activity warned, "We're entering a period where multiple factors converge: holiday-reduced operations, contract expiration deadlines, elevated delivery demand, and depleted inventories, creating perfect conditions for either exchange intervention through emergency rule changes or forced cash settlements that break the delivery mechanism." These signal breaking points, escalation moments where system stress exceeds designed capacity and forces either price explosion that clears imbalances or regulatory intervention that protects exchanges at contract holders' expense. A systemic repricing is still in progress, not complete. The divergence between Shanghai's $78 physical and COMEX's $70 paper hasn't resolved through either arbitrage or price adjustment, meaning the mechanism driving the squeeze continues operating beneath surface price stability. Final anchor data confirms continuation rather than resolution. Shanghai physical premium still exceeds $8 per ounce against COMEX futures as Asian markets prepare for overnight trading, backwardation persisting into year-end with front-month contracts bid above deferred months, signaling sustained physical stress. Spread anchor shows SGE COMEX differential unresolved at 11.4%. The gap between physical price of $78.49 and futures price near $70 remaining stubbornly wide, despite multiple trading sessions where arbitrage should have eliminated the divergence if metal were available to execute the trades. Inventory snapshot reveals SHFE vaults remain at decade lows below 446 tons. Chinese exchange stocks depleted through combination of export-driven drawdowns ahead of January 1st licensing restrictions and robust domestic industrial consumption that continues absorbing available supply faster than imports, and domestic production can replenish inventories. Observable market behavior into December 30th close shows premium stable or widening rather than compressing. Shanghai premium opened at $7.85 and closed at $8.15. London premium over COMEX expanded from $1.85 to $2.10 during overlap trading, and U.S. dealer premiums on retail products held steady at $9.12 despite end-of-month position squaring that typically compresses spreads. COMEX registered inventory data updated December 27th shows continued depletion. Warehouse stocks fell another 2.3 million ounces week over week. Conversion of eligible to registered insufficient to offset delivery requests, and eligible inventory remaining static, suggesting holders unwilling to commit metal to registered status at current price levels. Backwardation depth on near contracts measured at close. January futures bid $70.45, March futures bid $69.85, May futures bid $69.20. Each successive contract lower than nearer months, a curve structure that should not persist if market participants believed physical supply would improve in coming months. This data composite, persistent premium, sustained backwardation, depleted inventories, and stable or widening spreads, proves the squeeze continues operating rather than resolving, mechanism stress ongoing rather than relieved, and system imbalance intensifying rather than moderating as year-end approaches. Signal persistence as of December 30th close. Shanghai physical premium 8 per ounce against COMEX futures. Decade low SHFE inventories below 446 tons. Backwardation spanning near-term COMEX contracts by 60+ cents, and broken arbitrage mechanisms unable to close gaps. Composite data proving system stress continues unresolved as markets head into New Year trading and January delivery deadlines.